Donald Trump calms fears about imposing 100% tariffs on China, saying that wouldn't be sustainable. France's credit rating is downgraded, gold falls from its highs, and New Zealand's inflation rate may top 3%. That's coming up in our 5 Things in 5 Minutes on Monday, October the 20th. And then in part one of a deep dive interview, ANZ's head of geopolitical risk, Cameron Mitchell, describes a new era for geopolitics and trade.
We had the Bretton Woods era, we had the sort of WTO era, and now, according to Jamison Greer, we're in the Turnberry era. Turnberry, of course, is the name of Trump's golf course in Scotland, where the draft framework trade deal was struck with the European Union.
But first, in 5 and 5 with ANZ, the focus remains on Donald Trump's rhetoric around a trade deal with China. He eased some of those fears over the weekend, saying a new 100% tariff on China wouldn't be sustainable. Here's ANZ Group Chief Economist Richard Yetzinger.
It's difficult to see the reality through the smoke, you might say, given both sides have an interest in, skewing the public perception in their favour. It seems like the US is backing off, a more extreme outcome and looking to find a more negotiated outcome.
The S&P 500 closed up 0.5%, as did the Nasdaq. The 10-year US Treasury yield rose 3.3 basis points to close just above 4% at 4.009%. Gold fell 2.2% to $4,213 an ounce. More on that later. West Texas oil futures rose 0.1% to $57.54 a barrel. The US dollar index rose 0.1%. The Aussie dollar rose 0.2% to 64.97 US cents. And the Kiwi rose 0.1% to 57.27 US cents. Number 2. Another thing to watch is nervousness about regional bank stocks in the United States and their connections to private equity funds, which JP Morgan CEO Jamie Dimon refers to as a bunch of cockroaches. The collective noun for a bunch of cockroaches is an intrusion of cockroaches. Here's Richard again.
If you've been nervous about the global economy, last week gave you some pretty good reason maybe to raise your hand and say, well, I was right. And Jamie Dimon, who's been quoted on a few interesting phraseologies lately, suggested that where there's one cockroach, there might well be more. I think these issues are likely to remain idiosyncratic rather than become systemic. My reading of balance sheets, private sector balance sheets in general, is that they're in very good shape. And I don't see, the mispricing of credit on a broad scale that would be required for these things to become a serious threat to the global economy.
Number 3. France's credit rating was cut by 1 notch to A+ from AA- by Standard & Poor's over the weekend. Here's ANZ Head of FX Research, Marjabeen Zaman.
French political uncertainty has eased at the margin. The PM has remained in office after surviving 2 no-confidence votes. So, yield spreads have stabilized somewhat. And as a result, we have seen euro continue to move upwards. But then we do see there are some offsetting points here. So broadly, our year-end view does point to a 120 in the euro. But I think it will be a bit of a slow move up and it will be non-linear in terms of how it moves up.
Number 4. Gold fell on Friday night, but there's still plenty of buyers around, says Marjabeen, thanks to retail investors diving into exchange-traded funds. But wait, there's more, says Marjabeen.
Further to that, central bank purchases have also picked up in August, and in September we've seen, new buyers such as Brazil come in to add to their reserves. Not forgetting that, India's festive demand remains resilient. We've got Diwali this week, and I think there will be jewelry demand picking up there. Again, another supporter for an upside in gold prices.
Number 5. New Zealand will get an inflation reading later today with the potential for an annual rate for the September quarter of over 3%. In fact, 3.1% is the forecast from ANZ Research. ANZ senior economist Miles Workman says the Reserve Bank is likely to look through the breach of the upper end of its 1 to 3% target band.
So for the OCR outlook, it's really going to depend on how persistent the Reserve Bank think these inflation drivers are. Our forecast suggests it's largely tradables and probably not going to be too persistent. We do need to step back and remember that the New Zealand economy is operating with a considerable degree of spare capacity, suggesting that there is further underlying disinflation progress yet to play out.
Miles Workman there. Now, in our deep dive interview, I spoke about a whole new era in trade and geopolitics with ANZ's head of geopolitical risk, Cameron Mitchell, on the fringes of last month's AFR Asia Summit. Firstly, I asked him why Asian economies seem to have been quite resilient so far in the face of Donald Trump's tariffs.
I think the Liberation Day shock and awe sort of stabilised by August, and we started to see, I wouldn't say we don't have a clear tariff outlook. I'll explain why I don't think there's a clear outlook in a moment. But the levels that we're looking at through all of these framework trade agreements are lower, I think, than a lot of countries anticipated. No, they're not zero, but you've got a sort of a broad series of rates between around 10%, which of course Australia is on, through to 15%, which of course New Zealand is on. Some of the biggest manufacturing powers that the US trades with are on, the EU, South Korea and Japan. And then you're looking at around 19% for a lot of the ASEAN countries. So certainly not the 30s and so on that were on that novelty whiteboard that we saw on Liberation Day. I think the other important thing is that there's not a huge distinction within ASEAN on their tariff rates, because of course, whoever has a higher or lower tariff rate potentially has an advantage or a disadvantage over each other when they're trading with a partner like the US. So I think that's the other point to make. There might be a little bit of benefit for countries on those lower tariff rates now relative to countries that are on higher tariff rates.
And India, though?
Well, that's the good example. India is on a unusual tariff rate, what the Trump administration are describing as secondary tariffs. I'm used to the phrase secondary in the sanctions context, but this is important because I think it's a really insightful, I guess it's an example of what's going on in the United States, in Washington, around thinking on tariffs. Traditionally, if you wanted to affect a foreign policy outcome from a country, for the United States, one of the punitive measures you would have taken in the past was sanctions or export controls. We know now from the administration that they want to use tariffs in that way. The idea that you could trade through tariffs. So tariffs provide you with this degree of fungibility. The tariffs are through the executive branch. You can increase them or reduce them depending on the way in which your trading partner or adversary, whatever you want to call it, is responding. Whereas the sanctions and the export controls they're very much entrenched and hard to move. And I think that's really important because that's the insight that we're getting now from the US trade representative about what is being called the Turnberry system. We had the Bretton Woods era, we had the sort of WTO era, and now according to Jamison Greer, we're in the Turnberry era. Turnberry, of course, is the name of Trump's golf course in Scotland, where the draft framework trade deal was struck with the European Union. The reason I think this is important, I'm not sure if Turnberry is going to catch on, but the idea is that the United States is going to continue to use tariffs as a way to affect those foreign policy outcomes. I don't think we should expect a lot of consistency with tariff rates because, of course, the president, through the executive, has the capacity to move those rates as and when he sees fit.
Cameron Mitchell there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, October the 20th. Coming up tomorrow is part 2 of our deep dive interview with Cameron about this new trade era and whether traders and businesses think it will last. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.